Good morning, good afternoon, everybody, wherever you're located in the States. Thank you so much for joining our webinar today, Building Sustainable Financial Futures, Closing the Access Gap for Non-Standard Workers. My name is James Haberlin, and I'm with SteadyIQ. We're super excited to get into the conversation today and hearing what our guests have to say about the ways that we can tackle the challenges of supporting non-standard workers as they seek to secure their financial future, gain better access to financial products, and really begin to close the persistent wealth gap that non-traditional workers can face. Joining us today, we have Matt Ball from the Financial Health Network. The Financial Health Network unites industries, business leaders, policymakers, innovators, and visionaries in a shared mission to improve financial health for all. They do this work through education by investing in partnerships, companies, and helping to further this mission, empowering organizations and individuals to understand financial health, to find solutions, and cultivating a community of members through cross-section collaboration. Great to have you and good to see you again, Matt. We also have Shelley Stewart from the Aspen Institute, and Shelley is the director of the Future of Work Initiative for the Economic Opportunities Program. Shelley and her team, they strive to identify challenges faced by workers today and develop policy-based solutions to address those challenges and build a more equitable economy. Shelley is an economic sociologist and an applied scholar who has studied the changing nature of work for more than 10 years. She's an expert on the non-standard workforce, and she is the lead author of the Gig Economy Data Hub in collaboration with Cornell University's ILR School. Very excited to have you today, Shelley, and appreciate you joining remotely from a conference. And last but not least, we have Nneka Upahye from Better. Nneka and her team are working to make home ownership more simple, faster, and more accessible for all Americans. They recognize that the home ownership system needs an overhaul and are identifying ways to use technology to fix it. So this means a process that's fast and transparent. Nneka is a former attorney and faculty member of the Harvard Law School, so we're super excited to get her unique perspective and have her join Matt and Shelley today. So thank you all for being here. As I mentioned before, my name is James Haberlin. I'm the Chief Commercial Officer for SteadyIQ. SteadyIQ is the leading source of insight into the non-standard workforce. And we'll define that in a moment. We partner with employers, governments, and financial institutions to understand the 36% of the US workforce that's considered or defined as non-standard. Our technology enables income verification for non-standard workers, as well as real-time impact analysis and actionable insights on financial programs effectiveness. So we're thrilled to have everybody on the call today. As you know, the topic, building sustainable financial futures and closing the access gap for the non-standard workers. But first, let's level set and define what we're talking about when we say non-standard or non-traditional workers. There's many different ways to define this at SteadyIQ and in others in the industry, particularly the Financial Health Network and the Aspen Institute. When we think of what defines this type of a worker, we're generally talking about individuals, workers that are non-W2. So this encompasses independent contractors, freelancers, gig workers, independent contractors, self-employed or 1099, temporary workers. So all of these different work types kind of roll up to this broader category of a non-standard worker. This population, as you can see here on the slide, it's not a niche, right? We're talking about a third of all Americans, 1 in 3, are defined as non-standard workers. And by 2025, this population is projected to grow to 50% of the US workforce. So a real reality here. So Shelley, as the expert in the non-standard work arrangements, can you speak a little to what makes this work unique, especially in times when we're talking about income and savings, and what are some of the biggest challenges that face the non-standard workforce, which might impact their financial health and overall financial well-being?
Sure. Thanks, James, for the question, and thanks everyone for listening to this conversation. So as James pointed out, non-standard work is not one type of work or one type of jobs. And it includes actually an incredibly broad range of different work experiences. So it's defined against a specific model, that long-term, full-time, direct hire W-2 employment. And non-standard is a catch-all category for really everything else. And so it's important to highlight that diversity of experiences, types of work, and therefore challenges when we're talking about this really heterogeneous workforce. One of the key distinctions at play is the issue of worker classification. So this designation of whether workers are hired as employees, where they're given certain legal rights and protections, and the employer, the hiring company, exerts a certain level of control over the work conditions, or they're hired as independent contractors, jobs in which they should have total control over, their working conditions, the wages that they set, but at the same time, they're not covered by those same benefits and protections, things like a minimum wage, eligibility for a whole host of benefits, mandatory health insurance, Social Security contributions. And so that distinction carries a lot of weight. And there are workers that are sort of caught in between, where they're classified as independent contractors, lack those benefits and protections, but still do face a high level of control from the companies. And then there's workers on both sides. Even within this non-standard designation, you have temporary workers who are W-2 employees, still face a lot of challenges. And you have independent contractors who are really out there working independently, also face a lot of challenges. And some of the most common are around income stability, having the consistent income over time, volatility with a lot of spikes and dips, and a lack of predictability or transparency, not understanding kind of how much is going to be coming in the future, or how much of the money coming in has to be put towards expenses for future work. And then challenges around the lack of systems, when so much of our safety net, so many of our eligibility, whether they're public programs or private benefits, are structured around a specific type of employment, that leaves so many of these workers without key benefits and access to some of these tools.
Great. Thanks a lot, Shelley. That was great. Matt, I want to bounce over to you. You spend a lot of time building relationships with both employers to really help them, talk about the advancement of financial health of their workforce. Can you take a moment or two just to talk about how you approach that and what financial health looks like? Different from when you do this traditional employer-employee relationship. And as Shelley pointed out, maybe a little bit of talk about the misclassification of workers.
Yeah, sure. And thanks to James and the Study IQ team for inviting all of us here to have this conversation, because it's a really rich conversation. And in many ways, this is impacting employers in really profound ways. And I think employers are increasingly becoming aware of the role of the non-standard workers. Many of them have relationships with non-standard workers. And I think the pandemic and the corresponding labor crunch has accelerated the reliance upon the non-standard workforce. And so this is the time in my career, having done this for 15 plus years, where it's the first time where you see HR executives and other corporate leaders really thinking about non-standard workers as part of the company portfolio and apparatus. As Shelley pointed out, the barriers to providing the traditional workplace style benefits are really rooted in this misclassification penumbra. And so it's really about figuring out the evolution of those legal structures to provide greater opportunities for folks to gain access to some of the benefits. Now, it may not be through the employer, it may be some other things related to what certain states are trying to do, rather relative to portable benefits. But at the end of the day, it's really a challenge that's not just impacting the non-standard workers, it's impacting the way that employers seek to source and complete their talent profile. The other thing that I would say is really part of this conversation is many W-2 employees get what are called total reward statements. And so you'll get a statement from your employer that outlines all the benefits that are provided and the relative financial cost of that. Well, non-standard workers don't get any of those things. And so it's also really hard for non-standard workers to understand what they're missing out on, particularly some of the financial health benefits that are beyond just retirement plans and health insurance and some of the disability insurance and income protection solutions. But it's access to things like some of the payroll collateralized lending solutions that rely upon alternative underwriting mechanisms to provide folks with access to liquidity and capital that can be more easily captured through employer payroll systems. And so there's a whole ecosystem that's built up around this that really disadvantages non-standard workers in their financial lives.
That's great. Really, thank you, Shelley. Thanks, Matt. That's good stuff. Super interesting points. You know, from our perspective at SteadyIQ, we really see a lot of the inadequacies in serving this non-standard workforce. You know, the volatility of their income. You know, in the direct-to-consumer side of our business, the mobile app, we've got pretty powerful insights into how this workforce earns and how they spend, their behaviors. And we recently did a study of our members, our 6 million members, and we found that on average, there's $6 million in fees or repayments to payday lenders on a monthly basis. I mean, it's a staggering number that the inadequate or the lack of education of the types of fair or appropriately priced products that are out there really are not being utilized. And these members are continuing to kind of dig a hole and make less than optimal financial choices. So this really makes me want to shift the conversation to start talking about solutions. We want to pull NECA into the fold here. We have a good understanding of what we mean when we talk about non-standard workers now and the challenges that this workforce is faced with. You know, when we think about leaders, fintechs, nonprofits, and innovators, you know, what can we do to support this workforce and really reduce that wealth gap? You know, NECA, let's jump into your world here. We're hearing a lot about alternative data, which is different from the way in which lenders historically have underwritten using FICO scores. Want to learn a little bit from your perspective, you know, how are lenders viewing traditional kind of credit scoring today? What does this mean to you? And what's important for better when you think about alternative and kind of more creative ways to get comfortable with risk, but continue to support a workforce that needs the products that you offer?
Yeah, all great questions. And first and foremost, thank you for the invitation. It is quite an honor to share space with so many distinguished co-panelists, and also to have the opportunity to exchange ideas around how we can collectively work together to build a more equitable and financially inclusive ecosystem, and also to build sustainable financial futures for everyone, including non-standard workers. And I'd like to begin by acknowledging that traditional determinants of creditworthiness are in part to blame for many of the access gaps that we see today. And it's just a fact that people do not live and work and earn and save in the same manner that they did in the 1950s and the 1960s and the 1970s, when a lot of these frameworks were created. And so in my view, looking at alternative data is critically important. And it's something that's deeply personal to me. I'll share a brief story, if you'll indulge me. Having graduated from Harvard Law School, sometimes people look at my trajectory and think that things have always been easy. They think that I had it made, but the fact is I struggled financially in college and in law school. And so by the time I graduated law school, my credit score was in the gutter. And even though I had this very fancy degree and this very fancy job title and even a fancy salary, I was not able to get a single financial product from any mainstream lender. And so I had to turn to a predatory lender for things such as a car note. And so I would be remiss to not point out that gaps in financial access affect so many different portions of the workforce, including people who have jobs but might not have the traditional credit score or historical data that lenders typically look to. And even at the time, it didn't make a ton of sense to me, right? You could look in my account and see how much cash I had. You could look at my offer letter and see what my salary and bonus would be. There were so many other items that these lenders could have looked at to make a smarter lending decision, and they just chose not to because some archaic number said I wasn't worthy. And the way this shows up for non-standard workers is that some lenders quite literally have a box that asks whether this individual has been employed with the same employer for X number of months or a minimum of Y number of years. And again, I'm looking at this like, why does this make sense? And it's almost, and I know why that they have to, de-risk their lending products, but how might we look at other forms of data to supplement this very sort of antiquated model for determining someone's creditworthiness? And so in the mortgage industry in particular, there's a plethora of research out there around how to calculate someone's ability to repay and how to de-risk products. We have research from folks like the Urban Institute showing and proving that if someone has perfect rental history, that's just as strong an indicator of their ability to repay as having a conforming FICO score. And that makes sense, right? And when we look at non-standard workers applying for mortgages and not being able to check the box, saying that they've worked for the same employer for a minimum amount of time, if we look at their cash flow history in their accounts, if we see that their income has not dropped below a certain threshold for a certain amount of time, does it really matter whether or not that income is coming from one employer versus 4? And if it does matter, is anyone courageous enough to ask why? And so I'm constantly looking at different types of data sources and different ways that we can make products that make sense and meet people where they are. When you talk about rental-based underwriting, cash flow-based underwriting, and you layer in IoT, the Internet of Things, you layer in APIs, which is short for app programming interfaces. It's essentially what James was referring to earlier with the data insights that he gets with the direct-to-consumer Steady app. A lot of the apps that are on your phone have the same type of capabilities. And so when you aggregate this data, you get an opportunity to get a more comprehensive view of a person and of their behavioral patterns today. And I mean, I'll say it very plainly. I think using someone's past as the sole indicator of their present or future ability to access a financial product is inherently flawed. And the punchline of all of this is I think that we need to make a turn towards common sense underwriting. There's no shortage of data out there. Mortgage and insurance have been slow to adapt to this evolving environment, but the good news is we're starting to see a lot more tech integrations. We're starting to see a lot more API integrations, and it's giving us a more comprehensive picture of borrowers in order to enable us to make smarter and faster, and most importantly, more equitable lending decisions.
That's great. Thank you, Nneka. Matt, you and your colleagues at the Financial Health Network, you guys are in a really interesting catbird position. What are you seeing in terms of access to different types of financial products for this type of a worker and the challenges that they face?
Yeah, it's a great question. I think, Nneka had a really important point that I wanted to underscore, which is you don't often think of Harvard law grads as those that would go and have limited options in terms of access to capital. In fact, there are more payday lending stores in this country than there are McDonald's and Starbucks. And so the reason for that is because there are a lot of folks who we don't think would have to rely on those services that have to gain access to those services. And so I think that's a really important point just to emphasize is how the system will force folks into these really pernicious choice architectures that don't always allow for the type of human flourishing and growth that I think we are all committed to. And certainly that underlies the work we do here at the Financial Health Network, which is how do we unleash human dignity and potential? And doing that requires us to be really nimble and creative and agile in how we think about and advance the types of systems that are designed to limit the options for folks who do not come up through a preordained path towards success and prosperity. And this is also true as what we see in the workplace. And in fact, workplace has been an area, particularly employers, we've seen an explosion of innovation over the last several years. And a lot of employers have been learning from the direct-to-consumer markets, which were really first to come forward with some of these really interesting data sources and alternative ways to provide access to capital or access to liquidity. Because one of the big barriers we see with the income volatility, whether it's a non-standard worker or a W-2 worker, is income volatility. Most of folks, and particularly in lower wage jobs, are a car repair or a water heater or an unexpected medical bill away from calamity. And so access to liquidity has been a real focus for employers, especially coming out of the pandemic. And I think that, of course, relies upon thinking more agilely and creatively about how do you provide folks with access to non-predatory systems to provide short-term liquidity, but also, to Nneka's point, how do you get folks on a path towards those bigger term investments that require capital that underpin wealth building? And so I think there's a huge opportunity in the market to really push thinking around how do we advance the goals that I think we're all committed to, but it has to be a cross-functional operation. It requires a deep understanding of what's happening in people's lives.
Thank you, Matt. Appreciate that. Nneka, I want to bounce back over to you and maybe, double click on what you all are doing at Better. When we think about, trying to get folks into home ownership, your title is the head of financial innovation. I'm just curious, like, what does that mean? And like, what are the responsibilities that you've been charged with when we think about helping Better achieve your goals?
Great question. Head of financial innovation is just a fancy way of saying that I conceptualize and design new financial products and financial services to help more people achieve the dream of homeownership. So going back to your very eloquently put mission statement earlier when you introduced me, we're trying to make homeownership easier, faster, simpler, more accessible for all Americans, not just people with a FICO score high enough to qualify for a mortgage, not just for people with the income history to, check a box. And so when we think about how we meet that mandate for all, it really requires us to think of financial innovation in the terms of financial inclusion. And when we think about home ownership, it's particularly important because owning a home has never only just been about owning a home. It's about an opportunity to create intergenerational wealth and have an asset class that you can pass on to your children and their children. And so when people are on the sidelines and being denied access to wealth building opportunities like home ownership, it's really just perpetuating the very persistent and pervasive wage gap that we spoke about earlier. Now, what are we doing at Better to help combat some of this? One big thing that we've undertaken recently is to build our own mortgage marketplace. We're working with Palantir to do that. And what that's going to enable investors to do is get very granular and target specific census tracts, specific low to moderate income communities, even racial minorities for the right reasons, to identify communities and areas that need the capital injections the most. Another thing that we're doing that we've seen really move the needle and level the playing field is making all of our buyers cash buyers so that the everyday people can compete with trust fund babies and have just as strong an offer on the market. We've also been investing heavily in automation to sort of reduce the points of human bias that happen in any sort of lending decision or underwriting decision. And I would be remiss to not note here that the conversation around bias in artificial intelligence and also in algorithms, it's very timely and it's a conversation that's ongoing. But at Better, we're investing heavily in automation to reduce that as much as possible and make sure that our decisions are faster and completely data driven. And our CEO likes to say that numbers are the best adjectives. And we recently hit a milestone of $100 billion in volume, which is almost unheard of for any fintech. But in particular in the mortgage market. And when you think about that, that's a huge number. We helped a whole lot of people get access to homes. And even with that number being so big, there are still people falling out of our funnel every single day for various reasons, whether it be a credit score or debt to income ratio or other asset issues. And so for the people who are falling out of our funnel, how might we create new products and services that can help them also achieve the dream of homeownership so that we're staying true to our mission of making homeownership accessible for all? So one additional thing that we recently did, I launched Better's nonprofit arm. It's called the Better Opportunity Fund. It is a nonprofit loan fund, an aspiring community development financial institution. And the aim is very simple, is to try to help close the racial housing gap in this country, try to help close the gender housing gap in this country. And we're gonna do so by doing non-conforming products. I'm going up to 100% loan to value on these mortgages, in particular for teachers, first responders, et cetera. Just really being thoughtful around how we can create products that help people, even if they don't check every single box. So going back to rental-based underwriting, if someone is able to pay their rent on time every single month, why would they all of a sudden default on a mortgage if that mortgage is equal to or less than their rent? So I'm going to keep coming back to this idea of common sense underwriting. It sounds so simple, but it's something that so far the financial services industry has not been able to get right.
Awesome. Thanks a lot, Nneka. You guys are doing great work at Better, and It's great to see. Encourage you all to keep it up. When we think about technology and solving problems, some of the work that we're doing at Steady IQ is really to help help unlock access for this workforce as well. A year and a half ago, we launched or piloted an income passport product or income verification for the non-standard workforce. And while the foray into this kind of space was with the government sector to help claimants or beneficiaries get access to public benefit system, the public benefit system, Alabama and Louisiana specifically, to help them. The specific program was PUA, the Pandemic Unemployment Assistance Program. We're looking to scale that same type of technology into the financial services space to allow lenders that have historically said, I don't want to work with you, you don't fit in the box, I want to work with Matt or NECA, they're easier, they're round peg, round hole scenario. We're trying to level that playing field and increase that equality. So again, that's one of the ways that we're trying to play our role in this ecosystem to help solve this problem. There's a recent survey that found that half of 1099 workers were denied access to essential financial services, including credit cards, personal loans, mortgages, apartment leases, refinancing, and even vehicle or auto leases. And significantly, 20% of these workers reported that the reason they were denied was because they were unable to verify their current income. And 10% cited that they were denied due to the fact that they couldn't verify their past income. So we're hoping that this technology forward, user-friendly, user permission type of technology can help shift some of those dynamics and increase the equity and equality that that this panel is certainly hoping to achieve. We've talked about technology and innovation, how that can drive change. I want to bounce back over to Shelley a little bit. What can policymakers do to bring about change, Shelley? When we think about policy interventions, as what are you seeing? Understanding these workers' challenges, what can at the higher level, at the policy level, what can be done there to help enact change?
Yeah, it's an important question because as great as some of the solutions that are piloted by nonprofits and piloted by companies are, to really scale them and get them to solve these problems on a national level, we do need some policy intervention. And I kind of see the solutions falling into two kind of groups. And one is focused on the work and kind of some of the challenges inherent to the work to better equip those workers. So the first among these is addressing cases of misclassification. When companies are setting the conditions of work, they should be accountable to the legal rights and protections that create a floor for safe working conditions. And that is important and it's essential, but it is not enough. There are still plenty of bad jobs for employees, for W-2 employees. Some of these are considered non-standard, things like temp agency work or subcontracted work, and others are more traditional, but they have low and unstable wages. If you have hours that are all over the place, it's the same as working a gig job where you may work a lot one week and not at all the next week. They have few benefits, they have unsafe, unreliable conditions. Policy can set a floor to raise those standards. And then we also have true independent work that's not going anywhere and is not an issue of misclassification. That's work where people do set their rates, they're in control of their working conditions, and these people need access to safety net benefits, to legal protections. There are, portable benefits programs totally separated from the classification conversation that can extend some of these benefits more broadly. There are, wage theft protections. Cities across the country have put forward some of these protections in place that make sure that, all jobs, gig, non-gig, standard, non-standard, however it's categorized, that all jobs are good jobs. And that's up to policy to play a big role. And then the kind of other set of policy solutions is around some of these eligibility questions for various public programs, whether that's, lending, whether it's unemployment insurance, whether it's other insurance products and workplace benefits. Our current model tends to focus on exclusion, limiting who can gain access. How hard does it need to be eligible? Instead of designing systems to be inclusive intentionally, identify, who is most likely to be left out. How do we specifically reach out to and uplift those people? And those systems are going to benefit everyone. So when we think about unemployment insurance, the Pandemic Unemployment Assistance Program reached a lot of people, but still ran into problems that thankfully Steady was able to help out in a lot of cases. But why do we need to have so much eligibility challenges? Could we have a job seekers allowance that's available to, anyone who is seeking work and not currently in a job? When we look at financial qualifications for any number of programs, how can we make those more accessible? How can we make the application processes less burdensome instead of more burdensome? Should we be considering guaranteed income that actually facilitates stable employment? Again, both gig and non-gig, to get to kind of a shared floor of security that people can really thrive from.
Thank you, Shelley. I think it'd be an understatement to say that we're in suboptimal economic times right now, right? I mean, interest rates are going up, they're projected to go up, through the end of the year. Inflation is sitting at about 8.3%. Individuals are being forced to identify and supplement their income, looking to the gig economy. Our friends at the Pew Research found that just over half of all gig workers, they cited that needing to cover gaps or changes in income were the major drivers for them kind of leaning in on gig work. I'd love to hear from this group. Let's talk about actionability, like what can be done. From your perspectives, how do we go about leveling the playing field to ensure equity across all work types? What are some very tangible things that could be done? Let's start with NECA, and then we'll roll to Matt and Shelley.
Sure thing. That's such an important question. I'm of the belief that there can be no equity without empathy. And stated differently, empathy is a prerequisite for equity. And I'll tell you one more story because I like my stories. I was once in a room full of investors, and we asked the question for a show of hands, how many people in the room had ever been denied credit? And not a single hand went up. So lesson in knowing your audience, number one. But number two, it really made me very thoughtful about the fact that people in positions of leadership need to be more diverse. We need to invite different voices to the table, people who have the experiences, who can actually speak to ways that we can meet other people where they are. So that's number one. I would also love to see the GSEs, in particular in the mortgage space, the government-sponsored entities. I would love to see them expand their frameworks to be more inclusive around what qualifies and what checks the box. To Shelley's point, instead of being exclusionary, being more inclusive and catching more people in products that are considered conforming. I would love to see credit agencies track recurring payments that make good sense, common sense, rental payments, utility bills, the biggest items that people pay every single month, month over month, year over year, that are just not being captured in their creditworthiness and ability to repay. And I would love to see diversified credit modeling. I started my career as an antitrust lawyer for about 5 years, and competition is always good for the marketplace. FICO sort of has a monopoly on reporting on whether or not people are eligible for credit. And you have other modeling technologies such as Vantage. Vantage claims that they can score upwards of 30 or 40 million people who don't currently have a credit score at all. So why would we not expand the box and be more inclusive? And finally, I would love to see increased innovation and collaboration. I see it quite a bit now with tech companies in particular being more proactive about requesting sandboxes from regulators and sort of being able to proverbially play in the sandbox with their collaboration and also oversight. I think that the more we can do that, the better all of this ecosystem will be.
Yeah, it's going to be hard for me to add any additional nuance to what NECA, and I'm sure Shelley will, but I think one of the other points that I would underscore is this empathy-based model. And I think when I think of empathy-based model, that's not to say that it's Pollyannish or that we have to think about eliminating risk from the calculation of underwriting or the calculation of deployment of capital, but we have to think of ways that help us understand how folks are managing the predictable routine payments in their lives. And that requires us to understand how folks are living their lives and how they navigate their lives, to find those sources of information that are more accurate and true predictors of someone's creditworthiness and their ability to make those committed payments. I think there was good news earlier this year where medical debt is largely being stripped out of some of the credit reporting. That's really important. Medical debt is the #1 cause of bankruptcy in the United States. And unlike other forms of debt, it is often unpredictable and there's no transparency in the cost. And so a lot of surprise billing and other practices have really also undermined the ability for folks to navigate and get into creditworthy positions. And so I think as NECA is talking about sort of this empathy as a prerequisite to equity, it's really about bringing that deeper sense of humanity, understanding how folks live their daily lives, and using alternative data sources and innovation to bring forth that insight to make more informed underwriting decisions that more accurately reflect people's creditworthiness. So I often talk about this we have to de-risk by overemphasizing the empathy, because that's going to give us the best insight into how people are actually navigating their lives and predict their creditworthiness.
That's great stuff. Thanks, Matt. Shelley, how about you?
Now, I can keep things brief because the short answer is do all of those policy suggestions that I'd made earlier. Raise the floor for all types of work and really focus on designing systems to be inclusive, especially of those most likely to be left out by historical injustices.
Great. Thank you all. That was great. I'm going to ask one more question, but before I do so, I just want to remind the audience that if you do have a question for the panelists, please use the Q&A feature, lob those in, and we will share those with the panelists at the conclusion. But my final question, really want to do a round robin again for all the panelists, a bit of a crystal ball question. Are there solutions that we talked about today? Is this enough, right? Are we going to hit more challenges? What does the future for the non-standard worker look like? So again, maybe we'll start it off with NECA and then go around the room.
Sure thing. So I see non-standard work as the future of work, period. Younger millennials, Gen Z, they're non-conformists. I think that the older generation is sort of in denial about the fact that people do not want to return to traditional W-2 full-time jobs. You see this great resignation happening very proudly across LinkedIn with younger people turning intentionally to more gig work, more freelance work, and taking control over their time and their lives. And you see people, who might be immigrants from another country who are able to come here and earn a living wage without the same barriers to entry that you see with traditional jobs. So everyday people having the flexibility to really drive their own hours, prioritize other aspects of their lives. I think that that's here to stay. And I think that financial institutions who are willing to lean into that and embrace it and provide access earlier than other financial institutions, they're going to engender loyalty and win the future.
Great, thank you, NECA. Shelley, let's go to you, please.
Sure. So, my first answer to what is the future is always the future depends on the decisions that people make today. There is not a crystal ball. There's a lot of stuff to get done. And if people kind of in all sectors and in all roles commit to it, we can work towards a future where all jobs are good jobs that provide economic stability, that provide a chance for mobility, that provide equity, respect, and a voice. Whether these are arranged via an app or not, whether they're short-term or long-term in every industry, people should be able to access good jobs. And if we remember kind of that definition of non-standard work, it's work that falls outside of a traditional paradigm around which laws, protections, eligibility for benefits were all designed. And if we work towards universal protections and universal benefits that all workers can access, we don't need that non-standard designation. So as Nneka said, more and more people might work that way, but we don't need to see it as non-standard, as other, as different. We may see more and more different ways of working, including ones we haven't even imagined. But ideally, we don't want to see those as quote unquote non-standard. They should be like all ways of working and provide a decent standard of living, dignity, pathways to a brighter future. So I don't want there to be more non-standard work. I want there to be more good work.
I love it. That's great. How about you, Matt?
I like how you put me last to give me absolutely nothing to say after the brilliant comments from my fellow panelists. So one of the ways I think about this is the future is here. And so we're talking about some sort of state that's going to exist. And I agree with Shelley that the decision we make, but James, as your stats pointed out, 36% of the US workforce is already quote unquote non-standard. And so what that means is we're really trying to build the plane while flying it. So we really need to be thinking about more agile, nimble experimentation in new ways. And while I certainly think policy has to play a major role in that, I don't think nimble and agile are the first words that come to mind when we think about policymakers in doing that. So I think like the states and local municipalities, we heard reference to UBI programs, which have, I think there's almost 100 now across the country. Those are largely small towns and local towns that are really experimenting. And so I think finding ways to bring those insights through the pipeline up into the system to create some of the policy changes is absolutely important. But I also think the work that like Nneka and the private sector are doing to really use the skill sets of some of our most talented people to develop alternative solutions, to push large institutions and systems to advance that change, which then I think can help facilitate the types of policy changes that are going to be needed. So I think sometimes we say, what's the future look like? We think that it gives us a excuse to put it off. We're in the future, it's here. And so we need to move quickly, we need to move nimbly, we need to move agilely. And that's going to require a really big cross-section of stakeholders to bring that to life.
That's great. We all, all of you talked about things that actionability and things that can be done to move forward. I want to just comment that I see it. There's opportunity for encouragement, right? Like the work that everyone on this panel is doing today, like it's an awareness dimension. It starts with awareness, it starts with education, and all three of you in your respective roles are bringing that to bear. So for me, my take, and the Steady's take is that this is super encouraging, right? People are doing work. There's more work to be done, but definitely feeling optimistic about the various private, public sector stakeholders that are playing a role here. I'm going to turn it over to my colleague, Lexi Gervis, who's going to pose some questions to the panelists that came from the audience. So with that, I'll turn it over to Lexi.
Thank you so much, James. Hi again, everyone. We want to be sensitive to your time. We just have about a minute left. So we had some good questions, but I think we'll follow up an email afterwards. We'll send everyone the recording and we'll let you know some other questions that we're thinking about. And please feel free to get in touch with us. Thank you again so much to our incredible panel and James for hosting. This was a fantastic conversation and we're really excited to continue it afterwards and keep doing the work. So thank you all so much for joining.
Thank you.